Welcome. The difficulty level of this video is easy. Today we're going to talk about a major financial transaction in the technology sector, which you may have seen in the news. There is a financial technology company known as Stripe, which you may not have heard about until a year ago perhaps, unless you're in the financial technology sector. So this is a big success that is only now becoming apparent to people outside of this narrow subsector. What has happened is that Stripe has just closed a $600 million funding round at a valuation of $95 billion. Before the funding round, the valuation was $35 billion, already high, but now in one fell swoop, the $600 million funding round has increased the valuation by another $60 billion to $95 billion. This is a major uptick in valuation and is an event that in many ways is bigger than most IPOs that happen these days. $95 billion. So let's see what this round is about, and then we'll go through the history of what Stripe is about. As you can see from this news release from TechCrunch, I'll have a link below. We scroll down and see that this gives some detail about what the investor profile is like for this round. The backing of two major insurance players, Allianz and AXA, along with a bunch of syndicate investors. So these are the big institutional investors in that $600 million round. As we look further, though, the question becomes, why did they raise $600 million? Why not more? Why not less? And why did the valuation jump by so much? And is that justified? Well, to look at that, we're going to see some other data sources, and I want you to become familiar with these various data sources that I will keep referring to, and checking them often will give you some ability to analyze a lot of these private companies and get a feel for the pattern that is common to all of them. So we go to the CB Insights Unicorn list, a list of all the big private tech companies. And we see here that Stripe at $95 billion is the largest in the United States. It's the second largest overall, with only ByteDance from China being larger. Stripe is therefore even more valuable than SpaceX, which itself is $74 billion. But Stripe is the second largest private technology company in the United States today, and that is why they are preparing for their IPO. And this funding round is, of course, to simplify their financials and their cap table in preparation for their IPO. Now, what are the reasons that a company may go IPO, and are there times when they are forced to do it when they don't want to? The answer to that question is understanding the various dynamics at play. There are times, like right now, when going public can be beneficial for a high growth company because there's a lot of money in the market and it boosts their valuation further. Shareholders who have been tied up for a long time are able to cash out. Now, there's a lot of ethical gray areas about that between the mechanism that the investment bankers and the company itself use to pump up the price while insiders are able to sell versus the unsophisticated retail investors who often are deceived into buying at the top. But that is why we have regulators who look at each instance on a case-by-case basis. That may or may not have anything to do with the company in question over here. But other reasons why a company sometimes has to go public, and why would someone like Stripe wait until they're that big, 95 billion, and still remain private? There is a rule in which a private company cannot have more than 2,000 shareholders before being public. And there are ways to manage that situation, but eventually when a company has more than 2,000 shareholders, and that includes employees, the regulatory bodies will want them to be public. However, being public adds a lot of other difficulty. There's a whole host of new regulations that the management of the company have to follow. Also, when the market is not as hot as it is now, being public often makes the price of a company's stock go down because now they have to deal with short sellers. They have to deal with fluctuations based on news events. And those are things that a company that might not have been large for very long will have trouble growing into or adjusting into. They have to hire a lot of compliance people. There's a whole new layer of fees. Being public for a company of this size can add an additional $3 to $10 million a year of cost. sometimes quite a bit more if there are shareholder lawsuits and other things to worry about that are far less of a factor with private companies. So that is why many of these tech companies stay private until a very large valuation and delay going public until they reach a size such as this one. This was also true of companies such as Uber that stayed private as long as they possibly could. A link to this unicorn list will be in the description box below. From here, we will proceed to the history of this company and some information about who the founders are. Now, bear in mind, when a company has quickly gotten to a valuation of 95 billion, sure, the founders have become not just billionaires, but multi-billionaires. But beneath that, there is the support cast. Even the vice president level people perhaps made hundreds of millions of dollars if they joined early enough. And even the rank and file, like the product managers, the senior engineers, and the marketing directors, several of them might have made tens of millions of dollars too, depending on when they joined the company. So even someone who is, by any definition, a mid-level employee might have made 10, 20, 30 million dollars if they joined Stripe more than 3 years ago. You should go to LinkedIn and see if someone that you ever met works there and what title they currently hold there and how long ago they joined Stripe, and that'll give you some idea if that person has in fact made life-changing money simply on account of being an employee of Stripe over a sufficiently long period of time. Moving on to more internals about the company, from Crunchbase we can see that the funding amount raised is just 2.2 billion. So that means that there was considerably less dilution for this company relative to other companies of its size. The 600 million they just received is part of this 2.2 billion. This therefore means that the founders and early employees were not significantly diluted. When a company needs a lot of money to grow, the early shareholders receive dilution and then they own a very small percentage of the company when it reaches a certain size. But because of this relatively low amount, 2.2 billion, to build a $95 billion company, the dilution is not much and the founders probably still own a fair percentage, and so do early employees. So to look at that, we shall go to their Wikipedia page. So as we go to the Wikipedia page of the company, we can see over here that it was founded 11 years ago in 2010, so it's not an overnight success. You know, there were still a lot of years of hard work, but still a pretty fast rate of growth. And in the history, two brothers from Ireland, John and Patrick Collison, are the founders. Now let's see about them. This is one brother, only 30 years old, and net worth 11.4 billion. And the other brother, 32, also similar, 11.5 billion net worth. So between the two brothers, they have 23 billion in net worth, and they are in their early 30s. The younger one is in his very early 30s. It's safe to say their parents are quite proud. Good for them. They took what seemed like a relatively mature product category, which is internet payments and payment processing, and managed to create enough of an innovation around that they could build a very high value company in what seemingly was a somewhat mature space. Functions like PayPal, etc., have been around for 20 years, but there was still enough of a window for a company as large as Stripe to emerge well after the PayPal period. Therefore, consistent with Adam principles, as we know, there is a huge amount of money printing going on in the world. $400 billion a month as we speak, and $10 trillion just in the last year, partly to cushion the market impact of the COVID-19 crisis, but in accordance with Adam principles, that printing had to have been done anyway, and all that printed money finds its way into these high growth tech companies. Therefore, Stripe, which is the latest big wealth creation event in the technology sector and has made a lot of people very wealthy just today and yesterday, it's something to observe and something that I hope you found informative. I have been someone who published research reports in fintech and have been involved as an investment banker in fintech for some time. I also have taught this subject at Stanford University. So in coming videos, I will elaborate more on some of my research in that field and other innovation areas of fintech so that you are prepared to be fully aware of what is happening in this exciting sector. Hope you found this informative. Thanks for watching.